Hi, everyone, and thank you for coming to our webinar today. I'm Eliza Berry, the Marketing Director at Richie May. And just before we get started with our material, I wanted to run through a few housekeeping items. This webinar is being recorded. We will send out an email with a link to the slides and the recording in the next couple of days. Usually it's either tomorrow or Monday. You'll get that in your inbox. Please feel free to share that with anyone that you think might find this webinar helpful at your company. It's really quick and easy. Just forward the email over to them and they'll be able to access the links and everything in there as well. If you have any questions today on the webinar, go ahead and post those in the chat or in the questions panel. I'll be monitoring that throughout the webinar, and we'll definitely have some time for a Q&A at the end where we'll answer those questions. We have a jam-packed presentation today, so if we do run over time and you ask a question and we didn't get a chance to answer that, I will start an email thread with you and the presenters and our partner Steve at Richie May, and we will get all of those questions answered as you need. This is part of our capital education series, so thank you if you're joining us from our other sessions, or if you happen to miss those, just let us know and we'd be happy to send you the links to them as well. And so without further ado, we'll get an intro from our partner, Steve Vlasic at Richie May.
Hi everyone, my name is Steve Vlasic and I'm a partner here at Richie May. We're a CPA firm that specializes in alternative investments. And we're very excited to be rolling out the second part of our Richie May Capital Education Series. As a reminder, the reason we are putting this on is because whenever we speak with our clients and friends in the industry about audit and tax services, the topic of capital raising almost always comes up. So we wanted to bring some value to the industry and make everybody's life a little bit easier. In our first webinar, we covered the right type of investor for you, Rule 506B compared to 506C, along with some capital raising platforms that our clients can leverage. Some additional topics that we currently have in the pipeline are allocating money in the due diligence process, bringing on IRA money as an additional way to raise capital, and the perfect pitch book. We really hope you find this second part beneficial. And now I will hand this over to Steve Perrino and Carl Friedrich at Excelsior Investment Advisors, who are both a friend and a client of Richie May's. They will be discussing allocating money and the due diligence process behind it. Thank you.
Okay, thank you for that introduction, Steve. And with that, I think we can begin. So first, quick background. Thank you very much to Richie May. Thank you to Steve Vlasic. Thank you to the team there for having us today. We're excited to present to you today on the topic of allocating to hedge funds. First, a quick background on who we are at Excelsior Management. Excelsior Management is an alternative investment management firm specializing in hedge fund manager selection and portfolio construction. The firm has decades of due diligence experience and one of the longest continuous track records in the fund-to-funds business. In fact, I'm happy to say that just this past January of 2021, Excelsior Investments, our flagship fund, just celebrated its 30th anniversary. I'm Carl Friedrich. I'm the Chief Investment Officer and Head of Investment Due Diligence for Excelsior. A quick sense of my background. I've spent the last 10 years as an allocator to alternatives in the asset management space. Prior to that, I spent 9 years in hedge fund sales and trading at Goldman Sachs. Leading up to that time, I spent 4 years trading proprietary hedge fund strategies at a few different investment banks, including Nomura and NatWest. I have an MBA and a Master's of Science in Analytics from Indiana and a Bachelor's of Science in Economics from Wharton. Steve, your background?
Hi, I'm Steve Perrino. I'm an active status CPA with 20 years of alternative asset management experience as a CFO or Chief Operating Officer with 2 firms prior to becoming principal of Excelsior. Prior to that, I was CFO at Lehman Brothers Futures Asset Management, which was a division of Private Client Services, where I constructed funds of commodity trading advisors and funds of funds. I started my career at Coopers & Lybrand, where I audited financial services clients, and I obtained my undergraduate degree at SUNY Buffalo in accounting, finance, and management information systems.
Great. So here's an overview of the agenda today. We're actually going to try to do things a little bit differently to the extent we've got two different angles to present. I'm going to present to the investment due diligence side, and my partner Steve is going to present the operational due diligence side. So first, we'll go through a very short introduction to what is investment due diligence as it relates to hedge funds, and then what is operational due diligence. We'll then advance the discussion to some hot topics in investment due diligence and respectively operational due diligence. We'll then slow down a little bit and focus on 3 keys to success in the IDD and the ODD process, or at least in terms of how we run it here at Excelsior. And then we'll close out with near misses in IDD and ODD. I guess you could call that section like war stories, but we're going to talk about those situations where our process served us well. We managed to avoid making a mistake. So let's kick it off with what is investment due diligence. I'm going to actually start with a formal definition. I'm going to pull out Black's Law Dictionary, which defines due diligence, investment due diligence, as a prospective buyer's investigation and analysis of a target company or newly issued securities. I'm going to pivot from that and boil it down to what's really most relevant to us. We look at it as a quantitative and qualitative investigation that seeks to understand and verify an investment strategy and adherence thereto that's focused on driving a complete and informed investment decision. So with that, I'd actually like to pivot to explain that in a little bit more detail via a couple quotes. So first quote, what's past is prologue. Anyone, any English majors out there? It's William Shakespeare. Another quote that's relevant to our process. I want to believe in everything that you say because it sounds so good. Britney Spears. Where is he going with this? The first quote highlights the focus on the fund manager's performance and pedigree, while the second quote highlights the focus on positioning and, sorry, I don't have a fourth P here, disclosure. This is what we at Excelsior refer to as the what, where, and how of investment due diligence. But as far as the disclosure component, here's what I'm driving at. Here's why the topic of disclosure is so important. So if we can agree that a fund's positioning drives performance, then it logically follows that disclosure of the fund's investment activity ensures that the fund is delivering the promised position. This may seem rather basic, but a big part of our job as allocators is to understand what the strategy is and, importantly, reconcile that strategy not only with the performance on the output side, but also on positioning driving that performance. We simply can't afford to be fooled by good performance driven by improper positioning any more than we can afford to be fooled by bad performance on proper position. That is to say, there's a reason why funds have a mandate stated in their fund docs, and straying from those mandates is always a recipe for trouble down the road. Now, as for the inputs we review, here's a comprehensive list of the elements of quantitative and qualitative due diligence that we examine. This is Investment Performance 101 and not necessarily exclusive to the alt space. And to review each of these would be tedious and downright boring for you, the audience. So keep this presentation moving. I'd simply wish to confirm your expectation that these basic elements are considered as a part of our IDD process. Kick it over to Steve for the operational view.
Great, thanks, Carl. So while investment due diligence is the quantitative and qualitative study of a manager's strategy, operational due diligence is an investigation into the terms of the fund, the operations of the manager, the service providers utilized, the risk policies deployed, and the internal control procedures implemented by an organization. So, the process gets started by collecting materials such as the prospectus, the Form ADV, the marketing materials, audits, organization charts, references, newsletters, asset history, cyber landscape, and a list of vendors. Documents are reviewed and formed into a picture of the outside looking in. The goal is to identify areas that are not fully disclosed or appear to be inadequate to form an incomplete picture. These areas will be addressed at the on-site meeting. An on-site meeting will take place with the various department heads, and we'll come back to this later. The information from these meetings are analyzed and assembled into an overall picture of the organization. Deficiencies are identified for internal discussion. A final report is generated, and when the manager has completed the process to our satisfaction, a background check is performed on the firm and key members of the organization. Ongoing due diligence includes collecting materials, having quarterly calls at a high level, and an annual full on-site meeting with senior staff. Once again, the results are analyzed, summarized into a report, and these findings are compared to prior years to determine if the organization continues to adopt best practices or if new areas of concern are identified, such as compliance, litigation, turnover, etc. So I like to divide up operational due diligence into three categories. The investment manager sets the tone for the entire organization. Decisions are made at the top on items such as staffing, code of ethics, core firm values, firm level policies and procedures, compliance, firm governance, and insurance, and these are included in this review. The second category is operational due diligence on the fund. This includes the fund terms and the fund policies and procedures, such as cash controls, valuation policy, operational risk mitigation, and net asset value calculations. The third category is external service providers. This includes legal, audit, administration, valuation agents, compliance consultants, IT consultants, banks, executing brokers, and prime brokers.
Next, we'll take a look at hot topics in investment and operational due diligence. As you may recall, I closed out the prior section. Our approach to IDD focuses on the following elements. What the manager trades. Where they worked, and how. Of course, how they've done. Let's kick it off with the what of the strategy. What we're talking about here is the hedge fund strategy type. Now, to frame this discussion, I'd first like to outline for you the Excelsior view of the hedge fund strategy universe. And by the way, if you enjoyed the early classroom scenes of Dead Poet Society, I think it was Understanding Poetry by Dr. J. Evans Pritchett, PhD, you'll appreciate this very graphical approach. So first, I'm going to lay out two axes. I'm going to plot equity exposure on the y-axis in blue and fixed income exposure on the x-axis in brown. Investing's simplest form, a manager only buying stocks or only buying bonds, we'll lump those together as long-only strategies. And then to the extent we add leverage to the equation on the equity and or fixed income side, we'll call that long-only with leverage. But of course, you're saying, Carl, where's the hedge in your hedge fund investing? So we're going to go there next. We're going to extend the axes to include both short equity and short fixed income investing. And down here in this quadrant, where you can be short fixed income or only short equities, we're looking at short only investing. Returning leverage to the equity axis, we can begin to consider strategies that both go long and short securities. And most often on the equity side of the ledger, we'd be looking at strategies like long short and more specifically merger arbitrage, where the latter is actually investing in corporate takeovers and the like. Next, we'll add leverage to the fixed income axis, and now we can begin to include algo-driven quantitative strategies. And the motion here is an indication of the fact that they have the ability to reposition quickly based on model outputs and pivot between long-short combinations with varying degrees of market exposure. Now, those quantitative strategies tend to overlap with the market neutral strategies we look at, though at their core, not all market neutral strategies are quantitative, to be sure. And these tend to maintain low levels of directional market exposure, which is why I have them positioned so close to the origin here. Next, these arc lines along the equity axis actually indicate optionality or convexity, if you will. And this is typically how we view event-driven managers who play idiosyncratic situations that often have less linear outcomes. Adding a similar feature along the fixed income axis, while this could be optionality in the event of convertible bond arbitrage, but mainly we're referring to convexity embedded in fixed income structures, this is where we'll place fixed income arbitrage along this axis. Now, just beyond fixed income arbitrage, there are managers who will attempt to exploit inefficiencies in a company's capital structure. For example, maybe going long bonds and short the stock in the event of this lower right-hand quadrant here, or long stock, short bonds in the upper left-hand corner. That's capital structure arbitrage. And lastly, we'll add a third and fourth dimension, why not, to this to include commodities and currencies, and this is where we'll place global macro strategies, which tend to build thesis on broader economic themes and invest in them across asset classes to profit from those themes playing out. So now that I provided you a very simple to follow four-dimensional framework for exploring the range of hedge fund strategies, we can move on to the next topic. By the way, is no small part inspired by the New York City subway map. You're welcome. Next, where they've worked. Not nearly as graphically intense here, but naturally, depending on the length of the track record of the fund we're evaluating, prior experience can be especially illuminating as to the potential future performance of the fund manager. Generally, the frontline personnel we evaluate come primarily from three different industry segments. First, traditional asset managers or fund houses, fund houses, if you will, that run mutual funds, ETFs, SMAs, et cetera. These account for about maybe 10, 20% of the funds we evaluate, and often are less likely to have thoroughly developed hedged strategy acumen. Next, the investment banks, less so nowadays than maybe about 10 years ago, especially as proprietary trading on Wall Street essentially disappeared soon after Dodd-Frank came onto the scene in the late 2000s. But this pocket of talent sourcing still accounts for a good 20 to 30% of the managers we evaluate. And lastly, and unsurprisingly, a good 40 to 60% of the managers we're seriously evaluating have cut their teeth at other hedge funds. Next, how they've done. Of course, we want to know, show me that you can do it and do it well. So is your track record based on a back test? If so, we're going to take it with a massive grain of salt, because a back test is basically taking a model, applying it, but not necessarily investing real capital dollars. On the other end of the spectrum is, of course, the audited track record. That's the gold standard. Once we have verified that the strategy was applied consistently throughout the track record, this shows us the best tangible proof of a fund's capabilities and performance. And then the go-between is maybe the hybrid. And we see this quite often, actually, increasingly more so in the past 2 to 3 years, it seems. It's a combined back test and audited track. It falls in between, depending on how well the back test is tied to the audited track record. And then going beyond the data itself, the methods we use to evaluate this data is a lot more than reviewing return tables and VAMI charts. And so this teases the next section, in which we'll highlight our use of stress periods, conditional correlations, and AUM level impacts. Over to the ODD set.
Yep. So given today's environment with COVID and work from home, I chose to highlight a hot topic related to your review of third parties. This has become extremely important and critical part of a successful operation. If you're not already doing so, you should adopt the following protocol for reviewing your third parties. You should rank your vendor's risk level as either high or low by creating a risk matrix for all your vendors and be very specific with the information. Be sure to justify the existence of each vendor. From your matrix, you should conduct due diligence based on those in the high risk profile. Treat it like a full review. Collect documents relevant to the vendor's internal control procedures and cyber landscape. The review should include a thorough review of contracts, warranties, and non-disclosure agreements. Your review is essentially a full operational due diligence review of those vendors, and you should document conclusions and provide for a revised risk assessment at the conclusion of your review. This revised risk assessment should reflect a risk of low as a result of the controls in place by the vendor. And of course, your review is ongoing. Revisit your vendors annually and monitor them during the course of the year. Another hot topic in the industry is the availability of experts and big data. This data can come by way of conversations with experts. This slide represents names of many providers that I see used by managers today. Sorry, I'm having a little trouble with my slide advancing. There we go. Data can also be purchased from a great deal of additional big data vendors provided in the space. You may ask, why is this such a hot topic? Because non-compliance with the use of these providers could carry significant penalty or business interruption, possibly termination. Simple policies and procedures can be adopted to prevent your firm from acquiring or mishandling information that could be construed as insider information or breach of fiduciary duty by your firm. Procedures such as pre-call compliance approval, call chaperoning, compliance review of data gathered pre-trading, and adoption of restricted lists. These procedures are common sense and are designed to protect your firm from misusing material non-public information or mishandling of personally identifiable information. So, you may ask, what is material non-public information and personally identifiable information? Well, defined, material non-public information refers to corporate news or information that has not been made yet available to public, which could have an impact on a company's share price. Keep in mind that this determination may not be black and white, as evidenced by the many regulatory enforcements. Personally identifiable information is any representation of sensitive information that permits the identity of an individual to whom the information applies. It is the responsibility of the firm gathering and using such information to protect the sensitive data to which they now have access. Such information tends to be more black and white, which could be the reason why there has been very little enforcement actions taken by regulators to date. In either case, what should you do to protect the firm? Well, the Chief Compliance Officer should monitor the use and review information obtained from expert networks and big data. As we outlined on the previous slide, many of these procedures are common sense. However, there is a challenge, as there is with any compliance procedure. The challenge is that these procedures tend to you need to make sure that you evidence them. This means that the CCO should maintain documentation that their review, approval, or chaperoning of the data acquired has occurred. Of equal importance is a restricted list to impose necessary restrictions when employees come into possession of material non-public information or personally identifiable information.
Great. Next, we'll advance the discussion to 3 keys to success. We'll start with the investment due diligence side of the ledger. So I'm actually going to break this up. Hey, for the skiers in the room, by the way, hit those slopes now. The lift lines will never be shorter once everyone starts traveling again. Let's take a look at 3 key analytical approaches that we use by increasing level of sophistication. So first, we'll look at stress periods and time lens shifts. We'll then advance the intermediate level with exposures over time, and then finish up at the black diamond level with asset drags and conditional correlations. So first, stress periods. What I'd like to do here is really talk about the lens we use to evaluate the performance history of a manager. And here I'm going to show you just a typical fund manager return series. Obviously, we've got calendar year, we've got returns grouped by calendar year. Okay, they lay out the months for us. We've got the total performance by year. This is typically how you'll get performance relayed from a manager. And now what I'm going to show you is how we layer in degrees of data visualization to really get a better grasp of how to interpret the performance data, the performance history. You could probably barely see the change I just made, but all we did here was separate the quarters. This provides some lens of into the degree of cyclicality within the structure, but we're still operating within the confines of a calendar year. Next, we'll put a little bit of conditional formatting in place so we can at least differentiate the positive and negative returns, and far better than this, actually, the degree to which performance is differentiated on the positive and negative side. Nothing ultra fancy here, basic conditional formatting in Excel, but it starts to go a long way to start to compartmentalize the periods of return for the fund manager. The other thing we like to do is run a similar return series of the performance of the fund against the benchmark. Now we can see the degree to which they're producing alpha over the periods of a calendar year. And then stripping out the benchmark performance, you could do this next series actually on a standalone basis in terms of absolute return or on a relative basis. We like to highlight stress periods for the market. These are primarily equity stress market periods and how the performance of the fund manager, how the fund performed during those stress periods. We find this to be a particularly helpful lens into the performance history of the fund and also indicate degrees of conditional correlation, which I'll address later. Time lens shifts. At the end of the day, I just spent the entire prior slide looking at things through the lens of the calendar year. But at the end of the day, you know what? Calendar years are really so arbitrary. And what am I getting at here? And what I'm getting is that when you're looking at a performance history, the performance that's clustered between January and December, it really doesn't matter that it occurs during those artificial constraints. This is how we like to splice up performance. In this case, I'm actually looking at the fund manager's performance relative to a benchmark. Periods of outperformance are shaded in orange. Periods of underperformance are shaded in blue. What you're looking at here is along the x-axis, we have the start period from which we're evaluating them. So toward the middle there, you've got May of 2015. And then as you pan up and look to the left, you can see the end period. Think of it this way. The longest periods of time, of which there are the fewest, those are closest to the origin in the lower left-hand corner. And then as you start to scale your way out to the upper right, you have more periods to evaluate, but they're shorter in duration. So this particular line right here that I just highlighted in yellow, this diagonal line highlights approximately a series of 4.9-year periods, and you can evaluate the performance during those rolling periods. And then if we push a little bit further out, there are naturally more 3.3-year periods long. But the point I'm getting at is this. In applying this, and this can be done also with the Sharpe ratio, and my favorite is the Sortino ratio. We're basically looking at risk-adjusted returns, but risk-adjusted for downside performance only. This is where we really start to make inroads in terms of understanding a fund manager's ability to generate alpha over varying periods of time. So when you take into account where we actually started from in this analysis, we've come a really long way in terms of translating this performance history into actionable data. Next, exposures over time. So now, while performance is one thing, where the fund is exposed is another thing. And we find it critically important to review the exposure of the fund on a time series basis. So unlike before, where we're looking at periods of time, these are points in time, and we're looking at the exposure of the fund manager. And in this case, we're looking at it on a sector basis. So the reason why we call this stem and flower is we've got the one leaf on the one side is the long exposure within a given sector, expanding to the left with a green bar. Short exposure expanding to the right with a red bar. We've then got the stem of the flower, which indicates the degree of net long or net exposure or net short exposure on that line for that given month. And then the flower at the top is just the gross exposure. Obviously, we make liberal use of conditional formatting here. Again, a lot of this can be done in Excel. And we find that this is a very, very concise way to capture the evolution of the exposures of a fund manager over time. It can be done at the sector level to the extent it's a multi-strategy portfolio. It can also be done with their different strategies. And to drive the point home, you can also do this obviously with regional exposure. And a lot of this data is available from most managers through the form of an open protocol report and of course their tear sheets. Asset drags and conditional correlations. Here I'm going to talk about what we call COCO graphs. And no, I'm not talking about contingent convertibles out there for any hedge fund managers on the call. We're going to look at COCO graphs and Sabre graphs. Nothing to do with sabermetrics, but it's one of our own metrics that we like to look at in here in terms of understanding AUM impacts on performance levels. So conditional correlations, this is how we define them. Correlations to broad market indices. And the one thing we really like about correlation, denoted here by rho, is that it's a very statistically robust it's a statistically robust metric. And here's what I mean by that. You don't always need a lot of samples to get a statistically significant correlation. Remind you now, we're not trying to prove causation here, but we do need to understand the periods of time in which the fund's performance is going to be increasingly correlated to broader markets. We're going to start with the longest period of time available from the manager, so let's say the entirety of the track record, and we're going to strip out periods of broad market performance, starting with the best, in stepwise progression. And what this is going to do is it's going to highlight the potential for strategy correlation spikes in periods of market turbulence. Let me show you exactly what this looks like quickly. So we're going to graph on the left-hand side here. You see the fund performance, okay, positive performance above the zero line, negative performance below. The gray bars you see on the left there indicate the degree of fund performance. The blue triangle you see on the left there, that corresponds to the correlation, in this case to the S&P 500, the correlation level on the alternative y-axis across the way. And what we're going to do here is we're looking at S&P 500 performance up to the levels you see on the x-axis. So right now, to start, we're looking at 108 months worth of data, okay, for all periods in which the S&P 500 is performed up to 11%, which at the time we ran this analysis was all months in which the fund manager was active. As we slide this over, now we're only including S&P 500 performance up to 10%. So 1 month of data drops out. Next, we slide over S&P up to 9%, S&P 500 performance up to 8%, and we continue moving it across. And what you're starting to notice, if you're paying attention to those blue triangles there, that's what we're most focused on. That's the degree to which the fund's performance is correlated to the S&P 500. What's the trend that you're seeing? Well, what you're seeing is that as we now look at S&P 500 performance up to 0% in a given month. In other words, we're looking at all down months for the S&P. Well, when you're only looking at down months for the S&P, what originally looked like a 0.5 correlation is now a 0.7 correlation. And furthermore, as you pull back the lens a little bit further, S&P 500 performance up to -3%. In other words, S&P 500 down 3% or more, this fund manager's performance starts to look a lot more correlated to the S&P 500. The punchline here is this: what started out in the tear sheet for this manager as a 0.5 correlation to the S&P actually ends up being a 0.75 correlation to the S&P when S&P 500 performance is especially negative. That's what we call conditional correlation, and that's something you need to be really mindful of when evaluating how a particular manager fits into your portfolio. A couple snapshots of positive results. In this case here, remember I told you that correlation tends to be very consistently statistically significant. Well, in some cases when it's not, it's a non-issue. So in this case here, there's actually no point where we can really establish any type of statistical significance. There's no statistically significant correlation to S&P 500 for this fund. The next one we'll show is actually a declining correlation to the S&P 500. So while the correlation is high to begin with, at least as S&P 500 performance gets worse, your correlation declines. Next, we have an inconclusive result where we actually start out with about a 0.2 correlation to the S&P 500, but as we start to strip periods out, we drift into statistical insignificance. So really can't conclude much from this example. Same here. And then a negative result. So this is much like the first one we reviewed. What starts out as a 0.5 correlation actually jumps to a 0.8 when things get ugly. Here's another one where it's actually not statistically significant for the better periods, but starts to become very statistically significant when the S&P performs poorly. And here's one, same thing. Here's an ambiguous but leading result. This is one where the statistical significance of the correlation figure, it starts to pick up as the S&P 500 gets worse, but then the statistical significance drops off. But it's kind of a leading result. You can really start to get a sense of what you could expect if broad markets get particularly ugly, and that's in fact what we found to be the case with this manager when things happen. Moving on, asset drags on performance. I'd like to address what we call the bigger net fallacy. The bigger net fallacy has two key assumptions. First of all, that his track record is valid for a given manager, and second of all, the strategy has remained constant over that track record. The bigger net fallacy is the longer the track record, the better. So there have been many times where we go in front of an investment committee, they want to see the longest track record possible. Yes, long track records are good. However, just because the track record is long do you really actually want to use all of it? And there are cases actually where, despite having a lengthy track record, you may not want to use all of the data in that track record. This speaks to the Sabre ratio I went into earlier. I'm not going to boil this down. This is a proprietary metric that we've developed here at Excelsior. Suffice to say, it basically looks at the return of the fund on an adjusted basis. In this case, we're adjusting for AUM levels, and compares that to the actual returns of the fund. And then we rerun that for varying time series. So we start stripping out time frames. And what this tells us is, and first of all, handicaps the fund's alpha versus the benchmark by the month's AUM level relative to the fund's average AUM for the history of the fund. And then it repeats this for each time series by trimming the earliest period. This is what the output of this really looks like. So we had this one fund manager. These are simulated but correlated results for a given manager. And you can see that in the early phase here, between September of 2012 and about April of 2015, when you apply our methodology, this fund manager actually had about 2% of its performance was actually artificially inflated by suppressed AUM levels. Okay, so we can strip out that period of time. We can adjust to carve that out and focus on the period of time where they didn't have, as proven by the Sabre ratio, an undue tailwind from suppressed AUM levels. So in this case, we're going to run our analysis on the fund manager for all performance data February of 2016 and later. Now over to Steve for ODD.
Thanks, Carl. 3 keys to ODD success. So, as we mentioned at the beginning, the process gets started with a fund document review to formulate a view from the outside looking in. The documents reviewed include legal documents, such as the prospectus, the limited partnership agreement, and the subscription documents. From there, the terms are summarized. The review continues with a review of the manager prepared operational due diligence files, typically referred to as the AIMA DDQ. AIMA standing for the Alternative Investment Management Association's due diligence questionnaire. We collect audit reports. We review marketing presentations and newsletters. We review the SEC Form ADV, Part 1, Part 2A, and Part 2B. We take a close look at the organizational charts. We review the historical assets under management, and we look at a business continuity plan summary and a detailed representation of the technology landscape. Lastly, we will review a summary of the service providers. The purpose of this review is to identify potential areas of deficiency or areas not addressed by the material supplied. These items are identified and highlighted as areas to address during the interview process. What are some tips? If you have not done so already, you should complete an internal copy of an operational due diligence questionnaire. If you are unsure about your best practices, you can hire a consultant to perform a mock operational due diligence review. It is always better to build policies and procedures by committee. Management committees, operating committees, valuation committees, best execution committees. All these committees show a level of separation between upper management influence and the staff. It also enforces the adoption of best practices in your policies and procedures by all staff at all levels. Be sure to update your code of ethics and policies and procedures no less than annually, and don't share them with the examiner. Rather, just be willing to provide them with a table of contents. The interview. So, during the interview, you will be on site, or in the case of 2020, it could be a virtual meeting. And we're going to focus on the following. Document terms, particularly non-standard terms such as gating, side pockets, expense policy, and how those expenses are allocated. Organization. How is the organization structured? The number of staff responsible for areas of decision-making, and how controls are segregated. The independence of process away from the firm principal, or his or her inclusion as a committee member in operational areas other than trading, such as operational risks and counterparty risks. These will all be reviewed and discussed. Operations. The examiner will want to speak to the head of operations, the COO, or the chief financial officer. A detailed understanding about controls related to cash, pricing, net asset value calculations, trade settlement, and the use of third parties to provide independence to all operating procedures will be reviewed and discussed. Compliance and legal. The visit will include a discussion with the head of compliance, such as the chief compliance officer or a compliance consultant. Detailed about items such as personal trading, anti-money laundering, use of expert networks, due diligence on third parties, code of ethics, and periodic attestations by all staff will be reviewed and documented by the examiner. Technology and infrastructure. A conversation with the firm's technology team, such as the chief technology officer or technology consultant, will occur to assess the firm's preparedness for business interruption, remote working capabilities, backups, reliance upon servers either located locally or in the cloud, the length of a possible disruption time. The length of your possible disruption time should parallel the strategy you're running. A long trade equity manager could call trades directly into an executing broker, whereas a systematic black box or high frequency trader will need a sophisticated backup plan that will kick in much faster. In other words, the technology infrastructure needs to parallel the complexity of the strategy. What are some tips? Know more about your operational infrastructure than the examiner. The examiner has studied all of your materials. If you outline a policy that contradicts the supporting documents that you've supplied, this will be a red flag. Read your fund documents. In particular, understand the provisions related to expenses, concentration limits, side pocketing, and gating. Conduct mock interviews of staff to ensure consistent adoption of policies. These interviews do more than prepare you for an ODD exam. They actually foster best practice among staff. Know your third parties and their policies, as we previously discussed. Don't ask your ODD examiner for advice during the examination. If you don't have a policy, either explain why it is not needed or explain that that is a work in progress. Limit your discussion to future enhancements to those you're actively working on. Lack of progress or no progress is a deficiency. The examiner will intentionally leave extra time for you to talk about what you can do better or improve. This is a strategy of his to let you ramble. If you don't have a policy, adopt one and keep it simple. The on-site inspection. So at the conclusion of any good ODD meeting, there will be an on-site inspection, which will include the following: a request to see a trading area or a demo of a risk and/or trading system, especially if this is a virtual meeting. A request to meet people mentioned during the interview. A request to evidence locked areas, such as admission to the floor or IT closets. A request to see the server closet. Such a request should be accompanied by an IT professional. What are some tips? As discussed earlier, desks should be free of any personally identifiable information. Make sure that all locked areas are actually locked. You will be surprised. Ensure the server closet is well ventilated. Be prepared to show the desks of the department heads and where compliance sits in connection with those various departments. Provide for a demonstration of a trading and/or risk system, especially during a virtual meeting. Inform staff ahead of the ODD visit who will be visiting. The examiner will hear and see people in discussion during the office tour. This is a favorite of mine while walking around the floor.
Okay, now we'd like to take you through a few examples where our method saved us from allocating managers where we would have been disappointed. And I'll frame this particular IDD section in terms of the who, what, and where parameters I outlined earlier. So, first one. The first near miss keys off the where tenet of IDD we described earlier in the presentation. We found a team that specialized in trading fundamental equity pairs in anticipation of industry consolidation. With an impressive track record that measured up well against AUM biases and most conditional correlation stress tests. So in terms of the hedge fund strategy universe, this was clearly a long short strategy that had elements of event driven to it, but stopped short of playing the merger arbitrage per se. Now, the team running this strategy largely came from academic circles and had a track record that was developed mainly with a small number of investors, but with a steady capital base. And while we liked the strategy very much, we had a long-standing policy of avoiding concentrated industry exposure in a manager unless we had a specific mandate to build such sector exposure. So when we provided the feedback to the manager that we liked what they do very much, but found their concentration of the strategy into a narrow number of sectors, all cyclical, by the way, they insisted that their strategy was more event-driven than specifically long-short, than industry-specific long-short. Well, we passed, and lo and behold, the market conditions very soon arrived that were especially adverse to the sectors in which they operated, which actually wiped away a good 3 to 5 years of performance in just a single month. We feel that a more industry-tenured team would have better recognized that the strategy is dependent on a specific sector subset, and frankly, it would have spared us a lot of our inquiry efforts. The next strategy speaks to the what tenet of IDD described earlier. In this case, I'll share with you that the fund's focus was generally global macro with heavy elements of quantitative analysis, but run on a market neutral basis. We met this team at a CAP intro conference where they were billed as a group of industry tested PhDs who had produced an impressive track record, mainly at an investment bank, but before the Volcker rule came and eradicated prop trading in 2010. So in this case, we felt like we had a solid sense of the where they had come from and a pretty good sense of the how they had done. But at the CAP intro conference, and by the way, if you've attended any of these, you know that the group meeting format is not especially conducive to heavy probing of fund strategy. It's more of an overview that seeks to invite a more in-depth inquiry off-site. That said, during this introduction, the PMs were opaque, to say the least, about any core elements of their strategy. And in fact, they not only refused to share the core tenets of the strategy, they rather clearly indicated that any due diligence would yield little in terms of strategy, approach, methodology, risk protocols, etc., that had produced the prior returns. This team actually went on to successfully attract several $100 million in their first year, and at the same time, no investor really had the ability to ensure that the strategy was being adhered to. And as we monitored them over time, quarterly letters explained the fund's poor performance was largely, it was basically a scramble to hastily explain the strategy's adaptations in an evolving market where the models were just not working. Now, while this one was rather open and shut, of course, if you won't tell us what you're trading, we won't invest. It can be exceptionally hard to avoid popular teams with stellar track records and otherwise impressive credentials. The fact of the matter is you can't let the high-profile success tales in the Wall Street Journal indicate where you're willing to entrust your LP's investment dollars. The next near miss speaks to the signaling power of how the strategy is done in the past. In this case, we're talking about a primarily event-driven strategy that was deployed via capital structure ARB, and for this fund, the team's go-to security set was actually in the form of basic and exotic derivatives. There's a lot to like about this strategy. Steady returns in most months, several sudden quarters of strong absolute performance, generally a high Sharpe ratio strategy. That said, we didn't have to look far back in the strategy performance history to find periods of high conditional correlation. We spent a lot of time growing the fund managers on their 2015 drawdown during a period of time which we lumped together to form the global stock crisis of 2015, if you will. And based on the core strategy elements and portfolio construction, there really should not have been such a steep drawdown during this period. The management team went on to assure us that they had learned volumes during this period and that model adaptations had been made, precluding a repeat of another such drawdown. But as we began to wrap up our analysis and prepared arguments to lay out the credibility of these model adaptations, we were actually given a gift by the all-powerful Mr. Market. October 2018. So a combination of trade war threats, mainly between US and China, combined with the FOMC's taper tantrum. Simply put, the performance of this funds during October of 2018 should not have been possible if the model changes they made in the heels of 2015 had been deployed successfully. We communicated this to the manager and told them we were going to pause our due diligence efforts until the current market cycle completed. And that was a healthy instinct on our part, because what turned out, what the fund manager basically defined as a brief correction turned into a downward spiral, in which the fund would frankly never recover. The key lesson here is if a fund manager is going to give you a thesis on how prior performance in any fashion is not going to have a sustainable impact on the strategy, as an allocator, you simply must scrutinize that to the nth degree to be able to defend it. Put differently, there's only one thing more valuable to an allocator than good performance from the funds in which they're already invested, and that's bad performance from funds in which they're not yet invested. Over to the operational side.
Thanks, Carl. So these are near misses in operational due diligence, and these are all very real examples of deficiencies that have been detected along the way. First one is I like to call conflicts of interest. In this example, I was initially only permitted to do due diligence with the investor relations person. Upon pressing the investor relations person, she responded that she would set up a subsequent meeting with the firm's chief financial officer and chief compliance officer. The subsequent meeting revealed many inconsistencies between the policy that was described by the IR person. Upon further investigation, the people I actually met with were employees of the portfolio manager's father's firm. The father's firm traded the same strategy in a different, unrelated fund located in the same building. Upon confronting the portfolio manager, if you can believe this, he said he liked to run a flat organization, sharing employees with his father. He then tried to sell me on the fact that his father and he did not share portfolio names or trade ideas, or even that a conflict existed in the first place. The conflicts in this example are many. Background checks. Key executives should be vetted thoroughly. In this example, the portfolio manager actually misrepresented his education. Put this in the category of what was he thinking? This became apparent when the results of the background check were reviewed. This was an embarrassing conversation that had to be had with the portfolio manager, to say the least. Turnover. You should know that your chief executives bring independence to key procedures. In this example, the portfolio manager actually replaced the chief financial officer, the chief operating officer, and the chief compliance officer at the same time. Moreover, the CCO was replaced by the head of investor relations. I'm not really sure how well this was received by his investor base. In another example, the firm let the CCO go and actually failed to mention his departure during the quarterly call meetings. Even worse, during the annual face-to-face meeting, which requested his presence on the agenda, the CCO, who was clearly not present, was not even replaced with anyone, not even a compliance consultant, after he had been gone for 6 months. Pricing. In this example, the manager adopted an unacceptable valuation policy, where he marked the portfolio using single broker quotes or selected, mind you, the key word in this sentence is selected, a single quote from multiple quotes that were then provided to the administrator to mark the portfolio, no questions asked. The valuation policy was simply referred to as a pricing matrix that was supplied to the administrator. Upon digging in, this was clearly not an acceptable policy. Business continuity and disaster recovery. In this example, some of the parts, in this case, the parts being procedures, just did not equal a whole plan. While the server closet was the only server for the organization, which is okay, the backup of the data was a mere couple of feet below the server. To add to this poor plan, there were inconsistent stories that ensued about who took copies of the backup disks off-site, how often, and to where. Moreover, no consideration had been given to how long the system would be down if the power was lost in the building. Segregation of duties. Let me start by saying, Every manager can design a program with sufficient segregation of duties, even if you have 3 employees. In this example, the firm used poor judgment to let the CFO, who had single signing authority over wire entries and wire authorization. To add insult to injury, this was further complicated by the fact that the management company paid all invoices on behalf of the fund, and that the fund reimbursed the management company to the extent that the expenses were capped at 4%. I believe when you get done doing a little bit of math, that this ends up being a fee structure that is equal to 6 and 20. Side letters. The best example of this deficiency is the large investor who had a side letter which included preferential liquidity terms. The worst version of this I encountered had to do with a large seed investor with 60-day notice period that undercut traditional investors on a 90-day notice period. These investors were also subject to a gate that the seed investor was not bound by. Policies and procedures. I have 2 examples. In the first example, the manager inadvertently exceeded futures contract limits imposed by the exchange, and while the fine he received was an immaterial amount, it continued to happen on more than one occasion. In the second example, I had done due diligence on a manager who decided, instead of registering with the SEC, he would actually make mandatory distributions of capital to all investors to keep the assets below the registration requirement, which at the time was a much higher amount than it is today. While his policy was dubious, the manager actually failed to carry out the policy, blowing through the asset requirement and not registering with the SEC over the course of the next 12 months. So I believe that takes us to Q&A.
Yes, thank you for that presentation. As I mentioned at the top of the hour, this presentation is being recorded. So if you do have a hard stop at the end of the hour, then feel free to jump in and check the end part of the recording. We do have a couple of questions submitted, so we'll get through as many of those as we can. The first one is a question for Carl, re-industry concentration. So do you/Excelsior does not invest in sector-specific strategy hedge fund?
Well, the flagship fund currently does not. The flagship fund has a preference to avoid sector exposure. That said, we do occasionally have new fund mandates that do request specific fund exposure strategy. But if we're going to have sector exposure, we'd rather do it such that there's siloed sector exposure among several funds. But it's rare that we'll work that into the mix for our flagship fund, which is a diversified fund of funds.
Awesome, thanks for answering that one. We have another one. What software package do you use to produce the conditional correlation and stem and flower tables?
Those were all developed proprietarily. That's not something you could buy off the shelf anywhere. It's through a few years of iterating through Excel, VBA, and some minor programming. That's all developed internally.
Gotcha. Do you have a default list of operational due diligence questions you always ask each manager regardless of strategy focus?
It's a great question. We definitely start with a standardized email request. I typically include items that we listed in the presentation, such as the fund documents, internally prepared due diligence documents, audits, marketing docs, quarterly letters, AUM history, BCP summaries. But they do, as the due diligence gets going and we get into the weeds, the questions will get tailored to address anything specific or unique to the fund.
Gotcha. Do you use any third-party service to monitor the funds in which you invest?
Actually, 2 ways to answer that question. We stay on top of the funds ourselves. We don't rely on third parties. The buck stops with us, so we feel compelled to collect all the data firsthand, and we keep a careful data library. That said, we do leverage some third-party tools for collating some of that. Nothing that I shared in today's presentation, but sometimes it's useful just for standardized data to be able to collate that with third-party service, but it's not by any means our primary source.
Gotcha. And just a reminder to anyone that wanted to submit a question, go ahead and put that in through the chat or the questions panel. We just have one more before we wrap up. Do you ever invest in a fund that's not SEC registered?
Another great question. Yeah, thanks. Well, you know, the funds that we invest with are indeed SEC registered, but we have done reviews of managers who are approaching registration, and we've completed our due diligence in anticipation of being SEC registered. So, you know, we don't need them to be SEC registered at the time we start our review.
Gotcha. Okay, we had one more pop in. On operational due diligence for emerging managers, maybe only 1 to 2 per person kind of shop. How do you do ODD?
Well, it's going to really boil down to how segregation of duties have been deployed. Certainly going to be a challenge, but I'm going to be looking to see how the duties have been segregated and how that 2-person shop is leveraging off of their third parties, because the third party is going to be like essentially the third level of segregation. So it's going to be critical. Like an easy one to just mention would be the administrator. So if the administrator is independently valuing and striking the NAV, I'm able to lend an enormous amount of additional internal control to a process through the use of the third party. So that would be critical.
Awesome. Thank you for answering that. And here we are. We're at the top of the hour. So we'll just do a quick little wrap up here. Just as a reminder, this webinar is being recorded and the recording will be sent out to you. Feel free to share that to anyone that you think might benefit from this absolutely jam-packed presentation full of information. If you have any questions, feel free to respond to that email that is coming out with the assets that you can read over. You can respond right to that and we'll get you in touch with someone who can get your question answered. There is a brief survey that will pop up on your screen once the webinar closes. It's just 2 yes or no questions and a fill in the blank with any potential topics you'd like us to cover in the capital education series. Again, thank you everyone for attending, and we hope to see you at our future sessions of Richie May's value add educational series that we put out to, you know, benefit all of our clients and prospects out there in the industry. So again, thank you to our presenters today, and thank you to everyone for attending.
Thank you.